All right, I think we'll get going. I've always wanted to say this. My name's Evan Thornley and he's Mark Brilliant. Welcome to the Longview webinar on what we've called Property Investing 101. Some of the absolutely critical fundamentals to successful property investing. And many of you, I think, were drawn to this conversation by this page here. This is a really simple but fascinating exercise. Mark pulled this together. We wanted to look at just 4 property investments that were made 10 years ago now.
Yeah, about 10 years ago. So all these properties were purchased in a 12-month period of 2009, and they began all being sold in the last sort of 6 or 9 months. So they're
so it's a good experiment. We've got a perfect experiment, a real-time experiment here.
That's right, and obviously different properties in different locations, but all bought for around about the same price, sort of in about the mid 300,000s.
Right. So I think what we wanted to show you was how much difference it makes to buy a good investment property versus a property that doesn't share the same investment fundamentals. And those things are by no means obvious. So, Mark, why don't you give a very quick pretend pitch of what the real estate agent or the developer might have said when people bought these properties as investments, just to give people a flavour, but then we're going to go to, well, which properties did turn out to perform well. And what we'd like, a bit of audience participation. We'd like you to vote before we tell you the answer on which property you think was the best investment performer. On the right-hand side of your screen, you'll see a little dialogue box. And on that box, there's a little button called polls. You can press the poll and you can start voting on which property you think was the best performer anytime from now. First person who gets the correct answer and gets in there first, we'll give a special prize to. But I think it's a good exercise for you to think about if you want to wait and hear Mark's pitch, hear the pitch, but then we'll get your votes and then we'll review what the actual results were when these properties were sold last year. So, Mark, quickly tell us about Olive Grove, this property in Pascoe Vale.
Olive Grove, Pascoe Vale, sort of middle ring, northern suburb, a pretty modest, 3-bedroom home, nothing too flash, built in the 1980s. It's getting a little bit tired and it's a little bit daggy.
It's about 30 years old by the time it's on the market, and it sounds like it hadn't been renovated, so it wasn't too appealing.
That's right, just a basic, honest home, but probably the fundamental was that it had over 500 square metres of land, and it was also a corner, which is a bonus. Good family location, and just a good, honest sort of middle ring home.
So speaking of middle ring, the next one, it's a townhouse in this case, in Glen Ebor Avenue, Blackburn, nice near the lake in Blackburn. It's kind of, I don't know, it's a very average property to me, not in a bad way, just a kind of average suburb, average type of property, family home.
That's right. It's for young people or a young family, double-storey townhouse. But the key with this one is the location. So if you like Blackburn, this is just a couple of minute walk to the lake, a couple of minutes walk to the train and to the shops. So very, very convenient, but a decent townhouse. And probably one of the keys is that it had a really decent sized backyard. And a lovely alfresco deck, and it looks out straight across the footy oval behind the house. So nice. It's a really pleasant part of the world to live, and a really decent little townhouse.
Okay, then we've got what I think was sold brand new, a new apartment, inner city apartment, trendy neighbourhood in Windsor, right near Chapel Street. Fairly trendy new apartment building, nice looking properties, nice kitchens, bathrooms, everything.
Yeah,
nice
absolutely.
And new, easy to let.
Brand new, really popular spot. Very easy to rent to tenants, singles and young couples who are looking for that inner city lifestyle. It's only 700 metres to Windsor Station, to Chapel Street. So it's a real lifestyle location. This one was a top floor, so it had really decent natural light and a pretty decent outlook from the balcony.
So view. The bay from there.
That's right. So it had some good things going for it as an apartment. It was bought off the plan 10 years ago, and it's been sold now as a 10-year-old apartment.
Right, and then the last one. I mean, to me, Caroline Street, South Yarra is, I think, one of the streets that people would describe as a blue chip location in Melbourne. Probably one of the most sort of esteemed streets. So
absolutely,
very good location. Somewhat older apartment. This one.
That's right. Yeah. So older style flats. So. But you're right, it's the location that, again, is the real draw card here. So, very close to South Yarra Station, Faulkner Park, Toorak Road, the city, the Yarra, I mean, it's the perfect location again for young singles and couples, whether you want to own or rent it. You know, you have no trouble, renting out a property in this location. Compact apartment, made the best use of space. Again, it was elevated. I like elevated with these older ones. It gives the tenants a bit more security. And again, it had really decent natural light because it was elevated.
That sort of 60s modern movement architecture with the big floor-to-ceiling windows.
That's right, yeah.
So those were our little pretend pictures to the investors who bought each of these properties in 2009, all, I'm sure, with high hopes of a successful financial outcome.
Of course.
So this is your last chance to vote, folks. I can see some of you have done so and given us a range of different answers, which I think makes sense. There's different reasons why some of these might seem like they'd be better investments than others. But we'll now do what I think they say on the, is it the block, is the big reveal. Here's the 4 properties. They were bought, a bit of a difference between, I think, 310 and 390 at purchase price. So the Caroline Street was the cheapest. The Windsor, the brand new apartment, was more expensive. But look at what happened over 10 years. This is 10 years, not 50 years. I find this absolutely arresting. The difference in the amount of money these investors made is more than their total investment when they started. I mean, there's over $500,000 difference in outcome here.
Yeah, staggering.
For a group of people who only paid less than $400 when they began. So just the difference in the outcome is more than the total investment in only 10 years. I'm not sure how many people picked our little 30-year-old Plinker in Pascoe Vale as the top performer, but to buy at what's that, $350 and sell at $930 10 years later, making over 2.5 times your money, really a spectacular investment.
That's right.
We've calculated what the annual compound rate of return is. So that property grew 9% year on year, 9% on top of 9% on top of 9% for 10 years. And so you need about 7% annual growth to double your money in 10 years. So they did 2.5 times their money. The brand new apartment in Windsor, in this case, unfortunately, that investor's actually lost money, paid $390, sold for $375 10 years later. So no capital growth, in fact, a capital loss.
Negative, yeah.
The blue chip location, older style apartment, they've made a little bit of money, but it's as we would say, a bit the sound of one hand clapping. Our townhouse in Blackburn, it did pretty well. I said it was kind of average.
Yeah.
The Melbourne average is about 6 or 7%, and it did about average, which, given Melbourne's population growth is driving good property price growth, has done well. So I suspect that for many of you, those results were not obvious. Some of you may be quite shocked, both by which properties perform well and badly, but also by the magnitude of the difference. And it's because of that amount that we really focus first and foremost on capital growth as the single biggest driver of success in property investing. It doesn't mean that rental yield isn't important. It doesn't mean that depreciation or tax treatments aren't important. Those things all have an impact. But the compound rate of capital growth really dwarfs everything else.
It does.
So what we wanted to do today was unpack from these real live examples, why? Why did those properties perform well or badly? And we want to talk about 5 different factors that impact capital growth and impact the success of your property investment. And I want to highlight, we always look at things on an individual property basis. This is not a seminar that says, therefore go and buy Pascoe Vale. You can't buy a suburb. I think one of the tricks that the developer and real estate agency industry uses is using suburb average numbers as somehow endorsing the individual property they're trying to sell.
Quite a common
trick
in the industry.
really.
It is a trick, really.
I mean, every suburb in Melbourne on average has done well because Melbourne has done well because Melbourne's had such rapid population growth. But you don't buy a suburb, you buy an individual property. And deciding which property to buy is actually much more important than in which suburb it is contained.
There's plenty of properties in Windsor that have had 9 or 10% growth.
Right, including apartments. You showed you did a video on one yesterday.
That's right. So
really fantastic. So this is not saying don't buy apartments or don't buy Windsor or do buy Pascoe Vale. This is saying let's understand why.
There's apartments in Pascoe Vale that have had the same negative performance.
Right.
So
So we wanted to focus on 5 factors. Population growth we've already talked about. We won't talk about that anymore today, just because broadly across Melbourne that happens, although there are pockets that have greater levels, but it's just not our focus today. But just to say, as luck would have it, we've all been born in the right place or have moved to the right place. Melbourne is one of the fastest growing major Western cities, developed cities in the world. Growing much faster than, even big cities like LA or London. Melbourne really is growing very quickly. There's an MCG and a quarter of people moving here every year. COVID will change that in the short term, but in the long term, if anything, that will accelerate further. And so generally speaking, Melbourne benefits from population growth, which is a huge driver. So that part is easier for all of us. This, I think, is, if you left with one message from today, 4 words that are more important to property investment than any other. Land appreciates in value, buildings depreciate in value. So no matter how shiny that new kitchen is, no matter how nice the building is, a bit like a new car, it's worth less the moment you drive it off the lot.
Absolutely.
And every building goes down in value. Buildings never go up. It's the underlying land that goes up. So properties go up, but they go up because of their land value going up, not their building.
That's right. And I think if you use the Windsor example, it was shiny and new 10 years ago, and somebody paid a shiny and new price for it, much like a brand new car. But the building and the apartment itself has actually depreciated in value, and its smaller land content has meant that it hasn't had any growth.
And so just to highlight that, and we sort of saw it in these examples. So the first thing that we do when we're working with a client to help them buy the right investment property is we look at any particular property and we calculate what we call the land content. So just think of it this way. When you hand over money for a property, a portion of your money bought the share of the land that it's on, whether it's on a whole block of land as a single house or part of it as a townhouse or a villa, or a kind of little share of a block of land in an apartment. You bought some amount of dirt, as we say, and the rest of your money, whatever wasn't what you paid for the land or the share of the land, is what you must have paid for the building or the share of the building. The higher the proportion of your money that you use to pay for land, that's what we call a high land content, and that's the part of your money that's going to grow. The higher the proportion of your money that paid for the building on that land, that portion of your money is going to shrink. Now, thankfully, the land grows faster in value than the value of buildings shrink. So you've got to do fairly badly to lose money. Unfortunately, we saw one example where people did lose a little bit of money. But the higher the proportion of your money that's in the land, the higher the land content, the more exposure you have to the growing part of the asset, not the declining part. So in this example, if maybe this was a place in a regional city, the land wasn't worth very much, the building perhaps a new home or an outer suburban house and land.
Yeah, house and land package.
$100,000 worth of land, $300,000 worth of building. The land content is only 25% of your money is buying the land here. In this example, perhaps a little bit more like Olive Grove.
Maybe like Olive Grove was
an old 30-year-old house.
Yep.
The land itself was worth perhaps 80% of the money you paid. So you didn't actually pay much. You kind of got the house almost thrown in for free. And most of your money went into the land, and that's the part of your money that grew. And so, look, I've got a spreadsheet here. I won't try and take you through every number on this page. But every time you look at a property investment, the first thing you do is you say, well, how much am I buying land? How much am I buying buildings? And then you can project forward. Let's assume the land goes up maybe 7, 8, 10% per annum. It goes up quickly. Let's assume the building might depreciate. The tax department says it depreciates at 2.5% per year. 40 years life of a building. That's not a crazy number. Let's assume that. Then you cross multiply those, and the value of your land's going up, the value of your building's going down, depending on which factor outweighs which determines your outcome. So taking those types of numbers to the simple examples we had before, a property that was 3/4 building value and only a quarter land value, thankfully the land's gone up enough that it's covered the decline in the value of the building, but not by much. That's a bit like the South Yarra example we had there, the Caroline Street, bought for 400, sold for 450.
Very, very common with some of these apartments, Evan. We see that quite regularly where it's ticked along and it's made you a small profit, but even at 450, you're lucky when you sell that to cover the stamp duty that you paid on the way in and the agent fees on the way out. So,
whereas something where 80% of your money went into the appreciating part in the land, in this case, you would have bought for 400 and 10 years later sold for about 750. So that's land content, really critical driver of investment performance. The next question is, though, all land is not equal. and some land goes up much faster than others. We just before I go off land content, I think, Mark, you calculated here when these investors bought for about the same price these properties, how much of their money went into each part of the asset, how much in land, how much into building. And it's kind of not surprising to me that it exactly maps what happened in the overall investment performance.
That's right. I mean, Olive Grove was 515 square meters of land. It's got potential to renovate the house and extend it, or it's got potential to subdivide it. So the higher land content has got more opportunity, and it's grown at a lot quicker rate. Glen Ebor Avenue, it's a modest block of land, only about 140 square meters, but it still had a reasonable amount of dirt in a really, really popular location.
Good quality dirt.
Good quality dirt and a really decent sized backyard, really used the land well. The two apartments have got really, really small land content. They're buying a share of the larger block, and as such,
there was 27 apartments on the Dandenong Road side of about 1,300 square metres. So, right, you calculate, you bought 34 square metres of land.
That's right.
At Olive Grove, you bought 500 square metres of land.
Exactly.
So it's not surprising the investment performance mirrors that. Exactly. So the next question is, though, not all land is created equal.
No, it's not.
And so, firstly, we want to make sure that we're putting most of our money into land, into the dirt, as we say. The second point is, let's make sure we buy the best dirt, the stuff that's really going to go up in value. And what drives that, I'm giving you a hint here, is not just public transport, but is an idea we call scarcity. Is there something unusually good about the land that you're buying? Usually that's about the location of the land. Sometimes it might be about a view or its development potential or other things. But is there something unusually good about this land that most other land doesn't have? Because if there is, then more people will always want it, and it's unusually good. There's not that much of it. Demand exceeds supply, price will continue to go up. So we've given a simple example here. We're looking at Mount Waverley, a good middle ring suburb, lots of properties with good land content, 1960s brick veneers, sort of 20-year earlier version of what we saw in Pascoe Vale there. Yet some have appreciated much more than others with the same size land, same sort of lifestyle, same distance from the city. Why does some land appreciate more than others? Well, here's one example. One of the things you want in these middle ring suburbs is good access to public transport. If you do work or study in the city, you'd want to be close to the train station. But here's the thing. Not that many properties are really close to the train station. You'd love to be a 5-minute walk from the station. Everyone would love that, whether they catch the train every day or once a month.
Just once a week or whatever it is.
Or for the kids or whatever. But within a 5-minute walk of Mount Waverley Station, there's only 400 homes. Within a 20-minute walk of Mount Waverley Station, which is the longest I can imagine pretty much anyone would do it. I mean, on a wet Wednesday night, would you be walking more than 20 minutes? I don't think so. 4,000 homes are within a 20-minute walk. So there's 10 times as many properties within 20 minutes walk, and yet people want that less than the 10 times less properties that people want more. So unsurprisingly, the value of the land of those scarcer, unusually good quality of that land being close to the station in this case could be, I mean, the classic example is close to a beach.
The beach, yeah. The beach is a great example, obviously being on the beach with views, with water views, or 100 metres back or 500 metres back or a kilometre back, you can see the price just ripple out the same as your circles. So.
And you see it changing decade after decade. So the house that's right on the beach might have been worth 3 times as much as the property a kilometre away from the beach 10 years ago. Now it's worth 5 times as much. Right. So it's appreciating faster because it's scarce. There's more people coming to Melbourne all the time, more and more demand, more and more people want that, and there's no more of it, often less of it.
In fact, you often see, Evan, homes that are in that inner circle there where there's so few available. You sometimes see auctions like that where you get 7 or 8 bidders and the price just...
They call it the volcano auctions. It's like watching a pinball machine.
Whereas you don't tend to see those same results the further away from whatever it is that makes it that important.
So land content is a huge driver, but some land appreciates faster than others. Land which has unusually good characteristics that are scarce appreciates the most. Now, the fourth thing, again, so many of the things that drive value are not things that you can see from the pictures of the property. All the things that the developers and the real estate agents focus your attention on, may not be the things that matter. Mark, talk about this situation. These properties all look pretty similar to me.
Yeah,
so pretty similar size, similar lifestyle.
So these properties. These are all live examples of properties that have sold in Sunshine North in the last few months. We're looking in that area to find a development site for a client. And you're right, the houses are all much the same. They're all going to rent out for about the same, and they're all within a kilometre of each other, so they can still all walk to the same train and go to the same schools.
Right. So we've got about the same land content and about the same lifestyle.
That's
so
right.
It's not obvious that one's more valuable than the other.
Yeah. The key difference is the zoning. So the top one, for example, is zoned residential growth zone, and what that allows is that even on the same size block of land on 650 square metres, you can go 3 levels. You could build 5 townhouses as opposed to perhaps 3. And you could even do apartments as well.
3 levels, you might put a dozen apartments on it.
That's right.
Which you can't do in the other zones?
No.
Not allowed to.
So you're allowed to do some level of development, perhaps townhouses, but
2 villas or 3 villas, that's it?
That's right. So you can see what the people have paid there, 920,000, which works out to 1,415 per square metre. On the next one down, they've only paid 1,079 per square metre for about the same size block of land, only 500 metres down the road.
Right, but with different development potential.
Different development.
And then the other one's interesting to me, same zone between the second and the third, but just something, one's on a corner. Why does that matter?
So corners are great for development because instead of having to have a driveway straight down the side of the property,
which chews up half the land,
to access the back units, you can have the units all coming off the corner.
So their own just short driveways.
That's exactly right. So again, you might only be able to fit 3 townhouses on 626 square metres, but you can fit a 4th or a 5th one on a corner. And in fact, you can see it was actually smaller in land, 590 square metres.
Right, and yet they paid considerably more, even within the same zoning. Zoning. So this is the 4th characteristic that really impacts not just the value or the price you'll pay today, but impacts how quickly the value of that land will grow, because there's no more of that land. There's more and more people coming to Melbourne, more and more need to put higher density housing, to put in villas or townhouses or apartments. And when the developers are doing the math on how much they're willing to pay for the land, the more homes they can put on the land, the higher they'll pay.
Yeah. Hence the square metre rate there is a really good example, a really clear way of looking at it.
And I'll bet if we look at these properties 10 years from now, the difference, but all of them will do well, by the way, but the difference will probably have grown even more.
Even further.
Because that scarce developable land will be even more scarce and there'll be even more demand for it. So that gives you, I hope, a good understanding of some of the key fundamentals. This is a half-hour conversation. We can't talk about every factor that you should consider when you're looking to make an investment. I mean, Mark, you'd spend, weeks and months and probably hundreds of hours before advising a client to buy a single property. So
Absolutely.
There's a lot more goes into it than what we've had time to do here. There are some other factors that are obviously also going to be important to the value of the property and to its growth potential. Its nearness to other amenities, to schools, shops, hospitals, cafes, lifestyle, parks.
Yeah.
In Melbourne in particular, the northern light in winter just makes a property much more pleasant to live in, whether you're renting or buying. Obviously, only about a quarter of properties have north facing because
by definition,
they all face in 4 different directions. So that matters. Changing social landscapes matter. Places that might be, for example, difficult neighbourhoods with a lot of crime. If that changes, then clearly that makes them more attractive and they go up. Changes in infrastructure, or the new freeway that's going in the northeast of Melbourne, that will make that more attractive.
They were a good example because it's been highlighted as a growth zone. Sunshine will be an activity centre. Both state and federal governments are investing money to make it an education and medical hub.
Right, so it's a lot of relatively higher income people will be moving in there, whether renting or buying. So that's going to drive up those prices. So again, we're not trying to say property investment is simple or simplistic. It's a complex business. But what we've tried to do today is highlight what we think are the most important factors that put the biggest numbers on the page. Just before we finish, though, I want to talk about, well, why did the people that bought those other properties, why did they buy them? Were those people just foolish? Didn't they know any of this? Were they tricked? What happened? And I don't think they were. I don't think they were foolish people. They may not have known some of these investment fundamentals. But I think what happens is that the people who are trying to sell people investment properties, usually that they've just built, are going to use whatever argument they can. And they have arguments, and they're not bad arguments. They're just not the best argument. It's not that you get higher depreciation tax benefits, for example, on a new property.
Absolutely.
A new one. So and that matters. It's worth thousands of dollars every year. The negative gearing you can get on a property.
Absolutely.
These things matter. Of course, the rental yield matters. I mean, if we look at these properties now, if you think of the rental yield as kind of like, I call it the interest rate that your property is paying you to own it, right? It's what you get in your pocket once the tenants have paid their money, which we call the gross yield, and then you've subtracted your basic expenses, your maintenance, your rates, your insurance, property management costs, the net money you get in your pocket. Well, our property in Pascoe Vale is only paying you 1.8% of the value of the property every year. You're not getting much yield out of that.
This is very typical. And
right.
you tend to see that the properties with the highest capital growth tend to have the lowest rental returns.
Right.
And vice versa for the...
And so if somebody's focusing the investor on cash flow and yield, which is understandable, we all want to be able to,
service the loan.
The loan if we're borrowing money, which we usually are, then that Dandenong Road property would probably appear to be more attractive.
At 4.2% with today's interest rates, it's looking
right.
really good.
But we like to put the two together. How much money does the property make for you? Well, it makes it in two ways. It makes it in the growth of the capital value of the property, and it makes it in the cash flow you get every year. But as you can see from the numbers on this page, it's simply a mathematical fact that good capital growth is just a much bigger number than good yield. It's about 4 times more important. So it's not that the rental isn't important. It's not that the tax benefits associated with the rent aren't important and the depreciation. Those things matter, and they matter for considerable amounts of money. They just don't matter as much as capital growth. So these people weren't foolish. They weren't buying for no good reason. They weren't tricked into things with arguments that are false. They're just not the full picture.
That's right.
And that's what we try and give you. So hopefully, everyone, that's just given you a brief tester. We called it Property Investment 101, a bit like when you go to university, the first time you study the first, Economics 101 in first year. There's so much more in property investment than meets the eye. I think we all feel like we sort of know how to be property investors. We all live in homes. We all can get a feel for what we like and what we don't like, what we're comfortable with and familiar with. But there's more to it than meets the eye. And in fact, the eye is often misleading, I think, is one of the key lessons that we have here. So I hope that's been helpful. But what might be much more helpful is we've probably prompted a whole range of questions for you. Many of our existing Longview clients are on this call, might be thinking about their existing property, wondering whether it's performing well and why, or if it hasn't, what they should do about that. I know we've got people on the call who just saw this and were interested, might be looking to buy their first investment property, or people who might be looking to add to their portfolio. So there's probably a bunch of questions that this has prompted for people. So please type into the dialogue box on the right-hand side of your screen, questions or comments. Ruby, who's helping us here, will read them out to us in a moment. And we'll try and answer your questions. And, anything that you might have been quite disturbed, I suspect, in some cases by, the scale of the difference here and questions about your own property and how it's performing. Any question you have is probably one that other people also have. And so feel free to ask those questions and we'll answer them, or even just comments on what you've learned here and whether it makes sense. So, Mark, just while people are doing that, Anthony and I co-founded Longview, as you know, because we're not real estate people by background. I was in Silicon Valley. Anthony was a senior person at KPMG. We founded Longview because we started becoming property investors, and we found out it was more difficult than it first appeared. And yet, when we expected to get sort of high quality professional service from the industry, we were sort of surprised that didn't really happen. Tell me about what you do now for our clients, because you mainly do what we call professional purchasing. So you mainly help people buy homes. That's pretty unusual, isn't it?
It is. It's certainly a newer part of the industry, and I certainly wanted to get into it from traditional selling real estate when I realised that just exactly like you said, there's not enough. There doesn't seem to be enough helpful people helping and advising people on their purchasing decisions. And The challenge is if you don't know where to ask, you go to an open for inspection and you ask the real estate agent, and at the end of the day, they're there to just sell the property that they're working on. So they're not really there to provide advice.
And the last thing you want to do is buy the wrong property.
It makes such. I mean, you can see, Evan. We're literally talking about hundreds of thousands of dollars in difference over 5 and 10 and 20 years. So it's getting your purchase right, finding the right type of property with the right fundamentals is the number one decision that you make with any real estate transaction. So that's what I'm really, really passionate about, is helping people when the time is to buy their first or another property, is to make sure that it's going to get them the absolute best capital growth in the market. And we do that by following these basic principles and a whole lot more. It's obviously, as you said, there's a lot more that goes into it, but these fundamentals is where we start.
Gotcha.
Okay, so we do have a question.
Yes.
Can you get both high yield and high capital growth?
Okay, that's a great question. Question, if you didn't hear it, can you get both high yield and high capital growth? As Mark said earlier, the two do tend to work in opposite directions, because the yield is a calculation of the amount of rent you get divided by the purchase price of the property. Now, clearly, the higher the value of the property, the lower that number is for the same amount of rent. But there is a trick to it, though. So generally, it's hard to get both. I think it's fair to say. And so, to some extent, investors need to understand what it is they need and what they're looking for. Depends on their financial capacity, depends on their time frame. If you're moving into retirement, particularly in a low interest rate environment, and you're just looking for steady cash flow, you might be happy with a property that doesn't appreciate that much, but which gives you a better return on your money than leaving it in the bank. But for most people who are looking to longer term growth and the wealth creation that we talked about there, the capital growth is going to be more important, and the yield is therefore most likely on a high growth property to be lower. But I think there's one part of this that people don't understand, which is, while the yield may be lower today on that property, the yield will grow with the value of the property. And so I'm guessing when we think about that property at 11 Olive Grove, its rent now, I think on the previous page, its rent is higher than, for example, Dandenong Road, but the yield is lower because, of course, the value is so much higher now. It's 930 versus 370 odd. But I'll bet 10 years ago, when they were both purchased for the same purchase price, I'll bet the rent was lower at Pascoe Vale Road than it was at Dandenong Road. So the yield would have been lower, and the rent has grown more because the value of the property's grown more. And it's more attractive and harder to get.
Jumping ahead to property investment 102, you'd look at something like Olive Grove, and you can increase the yield with a renovation.
Right.
And so that's when it starts getting
right. And that's a relatively modest cost for a big change. And speaking of property investment 102 and 103 and subsequent classes, the next class we will be running talks all about why you would debt finance a portion of your property, and what we call leverage, and the massive impact the way you finance a property has on your results. It can matter almost as much as which property you buy. So, Ruby, you've got another question?
Yeah, thanks both to Gareth and Caitlin for your questions. We'll start with Gareth. He's asking about diversification and what our view is on building a portfolio with the units and houses in different locations.
Oh, look, great question, Gareth. So the question was, what's our view about diversification and different locations and or even different types of property, and how would you build a portfolio? I want to separate two slightly different but related ideas here, Gareth. One is the absolute investment performance, and the other one is risk and how to avoid risk. And you might have bought 5 properties like Olive Grove, all fairly similar, all within a few hundred metres of each other, all in Pascoe Vale, and they might have all done really well, but they might not have. And if something went wrong, crime increased in that suburb, or they decided to build a new freeway too close to it, or something, anything could happen, or somebody built a massive new block that sort of flooded the area with stock and perhaps with more difficult tenants, you would have taken a lot of risk. So one of the principal purposes in diversifying is to minimise your risk, even if that comes at a slightly lower return. So we see most property investors, for example, buy close to where they live. They feel,
That's-
I know this neighbourhood, I know what things are worth, so I'm not going to make a mistake.
It's very common, Evan, to see, your average mum and dad investor buy their first investment property in the suburb they live. But unfortunately, we see a lot of them buy a newer apartment because it's easier to finance.
Right.
And maybe they think, oh, well, my son or my daughter might live in there at one stage, and it makes sense. And they sort of go down that path without sort of diving deep on the research.
So I think, diversification of locations, you want to buy in thoughtful locations, but in slightly different areas is beneficial. If you're building a significant portfolio, actually buying in multiple states makes a big difference to your land tax bill. So that's a different form of diversification. But you might also want a diversification in housing type or even in property type. You may want to look at some commercial property as well. But for example, I know some clients who are very thoughtful. They're principally interested in long-term capital growth, and they buy high land content but low-yielding properties. That's their big focus. But in order to pay for that, they bought a couple of smaller high-yielding properties actually in regional cities. So the way the portfolio is blended together gives them the maximum exposure to the capital growth, but the high-yielding properties gives them the yield they need to pay for that and to pay for a relatively highly geared strategy with their finance.
One thing that I would suggest, we're talking to Gareth as well, would be to understand what his risk appetite and also, how hands-on with his portfolio is he prepared to be. Some people are looking for opportunities like those sunshine properties where, that's a 3, 5, 6 year plan, and then developing the property and then getting really maximise it. Some people are not interested in that at all, and other people are. So having a look at the profile of the client and what they're trying to achieve with their portfolio is important in what you actually do.
And again, that changes. We've helped a number of clients who bought for capital growth, and it served them very well. But now they're looking for yield as they move into retirement.
That's right.
And so they're gradually evolving their portfolio, gradually harvesting the successful capital investment they've made, and moving that, diversifying that portfolio and changing its shape over the next decade to be more yield oriented. So Gareth, we're fans of diversification because it lowers your average risk, and we're fans if it can achieve particular purposes for the total shape of the portfolio, and where it sometimes has benefits on things like land tax as well. Caitlin had a question?
Yes, from Caitlin, we have, how do you think about COVID-19 and its impacts on the residential property market? Which areas will be less impacted and which will be more?
Yeah, so look, we actually put out a video a little while ago, my colleague Anthony Cohen and I, about generally what we think is happening in the broader property market during COVID-19 and resulting. Our general view, and we can send you the link to that video, is that there will be less movement in property prices either way than a lot of the sensational headlines are suggesting. We actually think the market's mainly going to move kind of sideways, probably down a little bit, but nowhere near as much as the headlines are suggesting. And we talk about why we think those headlines are wrong and why the analysis there is wrong. But in simple terms, there are 4 factors that will drive medium-term general performance in the property market. And right now, 2 of them are positive and 2 of them are negative. Population growth historically has been a great positive, but because of COVID, it's suddenly come to a shuddering halt. So in the short term, that's a negative for property prices. But within a year or 2, we think that Melbourne becomes the migration destination of choice, given how well relatively Australia and Melbourne, although not this week perhaps, have managed things. So we think population growth will restart. Currently, it's negative. Interest rates, though, are incredibly low, lowest in history. So that's a huge positive. The balance of new stock coming into the market, if there's lots of new supply of properties, then obviously that floods the market and lowers prices. We've had the opposite. Melbourne was getting very tight for supply, and now no one's going to get anything out of the ground in the development industry. So even though the population growth is not its usual positive, the lack of supply is a general positive for prices. The biggest unknown is really what happens in the broader economy and what happens to money incomes. Clearly, that's a negative right now. Clearly, there's rises in unemployment and concerns. And what the scale of that will be and how deep the recession is, we don't know. So if that factor could outweigh the other 3, or it could balance out. So those are the 2 factors in favour and 2 factors against for the general market. Now, again, you've asked, Caitlin, what properties in particular, what areas? And again, I don't like talking about areas separate to properties themselves because the individual property is more important than the suburb. because the qualities of the property. That being said, the place where the biggest depopulation has happened is close to universities and places where Airbnbs have moved into the traditional rental market and places where young adults have left and moved back in with mum and dad. The inner city apartment sector has been absolutely smashed, both in rental prices and I believe that will fold into sale prices. So what I would not be doing right now is buying an apartment in the inner city. But if I was looking at a property like 11 Olive Grove, Pascoe Vale or Glen Ebor Avenue in Blackburn, which I would prefer to buy anyway because of the land content and the scarcity, I don't think the prices of those are going to move much at all. I think the balance will be about even in the short term, and in the long term, I think all four of those factors actually go positive. So, the most important thing is to buy a great property, and it will perform and outperform the market.
Even I've always said that by buying an A-grade property, you're going to insulate yourself better when there's a downturn. And the top, Olive Grove and Glen Ebor are great examples of A-grade property that are really not going to see, huge dips right now. It's the lower quality properties that have got more compromises and more fundamental things wrong with them that they're going to take this biggest dip. And the COVID and the Airbnb situation is really just going to amplify that. So it's about, regardless of whether the market's at the bottom or the market's in a boom, it doesn't matter. It's about getting the fundamentals of your purchase right. It's about getting the land content, the location, the size, everything, getting that right. So no matter
you outperform the market, whatever the market does.
And when the market bounces back as it will, you'll see that Olive Grove and Glen Ebor will take off. And unfortunately, Dandenong Road and Caroline Street will just continue to plod along, regardless of if the rest of the market is going.
I think, Caitlin, the other sector which I think will be hit in the short term, but which I'm less negative about medium term, would be outer suburban house and land packages, because the population growth that they were built to capture in the next year or two is going to be very slow in coming. So I think those areas will have relatively poor price performance in the short to medium term.
Agents that I've spoken to in those areas did notice a real quite sudden decline a couple of months ago. The shot in the arm from the building incentives that the government have helped a little, but it's only going to help so much.
But I suspect well located properties in those outer suburban rings, particularly those close to our ever growing and more efficient rail network, will turn out to be good investments in the long term, but possibly not in the short term. But then you shouldn't be buying a property to invest in it unless you're going to do something very material to it, like redevelop it or completely renovate or change it. You shouldn't be buying it in the first place unless you're looking at least 5 to 10 years. So I wouldn't be too concerned about the short-term impact on those properties. The question is it the right property? Got a couple more questions, Ruby?
Yes, we have a question from Dee. They want to return from living overseas, and they're wondering whether these principles still apply for them if they're investing from overseas before they return home.
Okay, so question from Dee, if you didn't hear it. Thinking of returning home from overseas, I think there's a lot of people going to be returning home from overseas, frankly, given, unfortunately, the terrible state of things in North America and Europe in particular. And wondered if these principles still apply to someone from overseas. Broadly, they do. It would have been a great time to buy, actually, right at the middle of COVID, when the 2-for-1 special was going on the Aussie dollar and you got it at 56 cents US. It's now up at about 70. And as you may be aware, Dee, there are additional penalties now being imposed on foreign buyers. If you're planning to stay overseas for a long time, you do get hit with more significant capital gains tax. You don't want to leave the property empty, as some overseas buyers have done historically, because you get hit with a special vacancy tax. So your overall performance, unfortunately, and you won't get, depending on your personal tax arrangements, you may not get the negative gearing benefits on Australian income tax. So in general terms, if you're planning to stay overseas for a longer period of time, your total investment performance won't be as good for you on the same property as it would be if you were an Australian domestic resident. But I don't think it would change the type of property that you'd be looking to buy.
No, definitely not.
Just unfortunately will impact your returns a little bit. But then other factors, particularly currency, could work in the opposite direction. I mean, I admit I was in Silicon Valley for a long time. We bought our farm when the 2-for-1 special was going on the Aussie dollar at 51 cents in the year 2000. And by the time it had got up over $1, we'd made a lot of money by buying at the right time with the currency. So there's different factors when you're buying from overseas.
We've got a question from Andrew. How much of an impact on time to buy should the current banking policies around payment deferrals have?
Oh, look, again, it's a little hard to know. The question was about the impact of the current banking deferrals, which are now being extended beyond September.
Yeah.
And whether, I think where Andrew's going with that question is, if the banking deferrals all come to an end and things get really ugly out there, probably early next year, will that mean there's a flood of desperate sellers who have to sell because they can't meet when the banking holiday ends? Look, it's a good question, Andrew. And of course, unfortunately, none of us know the extent of what's going to happen with the broader economy and how much people will be in that situation. It's usually unemployment that causes that more than any other factor, and we just don't know where that will be at. So in many ways, answering your question is more a speculation on the state of the economy than it is on property. My own general observation is that Australia is in such a relatively good fiscal position. The government has such low debt to GDP versus virtually any other country in the Western world that it's in a position to fund the hole in the economy for quite a long time. And it has enormous political pressure it can put on the banks to do so as well. So my personal suspicion is that there's not going to be an apocalyptic either economic crash or banking crisis, that those things will be smoothed through to a soft landing. And then, frankly, migration-driven growth, I think, will put Australia into a long-term boom within 2 years from now, with the people like Dee and others who are moving home or others who want to come to Australia. So I wouldn't necessarily hold out for super bargains when the banking holiday ends. But again, whatever difference there is, even if prices, you could find something 10 or 15% cheaper next January than you can now. 10 years from now, that is going to matter not one bit compared to whether you bought the right property or not.
That's right.
If you bought Dandenong Road for 20% less in 2009, you still bought a dog. And so, we would always say, it was the point Mark was making before, it's the qualities of the individual property and its long-term capital growth more than the broader market. If you can find a great property at a fair price, buy it all day long. You may get more properties. Usually the great ones won't come on the market in a distressed market because the owners will be able to hold on because they've probably made a lot more money while holding it in the first place. So I'm not by any means saying don't be opportunistic. There will be some forced sellers, and some of those forced sellers will have good properties, and you really need to know what you're doing because they will get snapped up very quickly. So there'll be a little bit of that happening, but I would mainly focus on just thinking about the right type of property with the right type of investment profile for you, Andrew, and your family and your needs over the long term. And then once you're clear on that, then by all means, let's work together and be opportunistic about finding the best opportunity, whether it's driven by a banking crash or any other external factors outside our control. Okay, I think that's all we have. I think we're going to let you all get back to your lockdown preparation. A bit of dark humour. It's a difficult time. But look, one of the things that we're all doing, I guess, as we go back into lockdown, it gives us a bit more time to think and sort of reflect on our lives, on our the important relationships in our lives and where our lives are going. Part of that for some people will be thinking about what they're doing longer term in terms of investment in property, their existing investment properties, or whether they want to buy a new one, or whether they're worried about whether they bought the right one in the first place and what they could do about that. So we're going to try and produce more of these webinars to give a broader understanding to more people. But obviously, we're available anytime, no charge to kick around your ideas, understand your needs, and help you think about it. And then, if you want to engage us professionally, we work with you closely to get the right outcome. And we're called Longview for a reason. We're here to help our clients have long-term success in their property investment journey. We're not here to make short-term money for ourselves. We're not going to pretend we're going to make you short-term money. We try and align our efforts with your interests so that over the long haul, we can all build a prosperous future together. So thanks for your time today. Look forward to talking with some of you in future. Great to see many of our Longview clients here. all of these things, of course, are free to anyone who's a Longview client. If we're managing your property or we're assisting you in buying or selling properties, Longview service is complete in that sense. And if you're not currently a Longview client, we look forward to an opportunity to understand your needs and see if we can help with them now or in the future. Thanks for your time.